Good evening, ladies and gentlemen. Can I welcome you here to the Source in Sheffield and to this, our annual fund meeting for 2017. Thank you for turning out on what is a particularly horrible evening. I'm very quickly just going to go over a few housekeeping issues. We are not expecting a fire alarm to go off this evening, so if one goes off, we need to evacuate the building. There's a fire escape there, through those double doors there, and there's another fire escape just along the corridor and to the right, close to where the lift is. The toilets are again down that corridor, the back of the room, and on the left-hand side. And, sorry, I should have said, once we go downstairs, in case of a fire evacuation, out of the front door, turn left, and walk towards a quite distinct green pole. Apparently, you'll spot it. I didn't spot it coming in, but you'll spot it on the way out. The only other thing I wanted to raise was in your packs this evening, you've got the slides for the presentations. It suggests that we'll raise questions on each of the presenters' presentations at the end of each one. What we're going to do, just to expedite things and be a little bit more efficient, we're going to wait until all Gary and Steve have given their presentations, and then we'll open it up for general questions at the end, if that's okay. I just think we'll get through the programme a little bit quicker. So that's all I needed to say. I'd like to now hand you over to the Chair of the South Yorkshire Pensions Authority, Councillor Sue Ellis.
Good evening, ladies and gentlemen. It's lovely to see you again. There's a lot of people here that come every year, and a particularly warm welcome to you, because we do really appreciate you taking your time to come and listen to us give our report back. I think it's hugely important that it's very transparent to you and that you have this opportunity to question us and get all the explanations and reassurance that you deserve. But I'd just like to start with some introductions. I'm Sue Ellis, as I've already said, and I'm the Chair. Dick Wraith is my Vice Chair. He's a councillor from Barnsley. Then we have Steve Barrett, who's the Interim Fund Director, and we introduced him for the first time last year. And then we have Head of Pensions Administration, Gary, and I don't know how many years ago that we first introduced you. I just want to reassure you that this is a key event in our calendar, and it really is a pleasure. And we have the officers here and towards the back, and we are all here genuinely to answer any questions that you've had. Last year when I stood here, I talked to you a lot about the problems that we were having with our software, and not so much me, but Gary and his team, and how that was impacting on our performance. I'm glad to say that that is much improving. We have restructured and we've put additional staff in, so hopefully that performance won't be impacting on you too much. And today we had a meeting, and just to emphasise that fact, in one quarter alone there were 18,000 casework areas to look into, and 24,000 supporting tasks that went with that. And I think that software is now allowing us to be rigorous in where our work is and make sure that we're in the best position to keep up our performance. The other great area of work that we've been doing this year, and I mentioned it last year, is the government policy of amalgamating local pension funds into pools. And I reported to you that we were hoping to join the Border to Coast pool, which we now have, and that is 12 funds coming together, and we've all now formally agreed to that. And this gives us £45 billion worth to invest on your behalf and all those other members in there. Quite a big task there. And I'm really pleased because out of that we obviously have a chair, and Councillor John Wheel was elected as the chair for Border to Coast, and he's a councillor from North Yorkshire, and I was elected as the vice chair, and we're making quite a good team, and I'm pleased with the progress we've made under very demanding timescales, which are the government's, obviously. The next 12 months I am anticipating to be just as challenging as the last, but it really is worth it when you think of the necessity of pensions and the part they play in your life and our life. Now, the rest of the evening will be filled with Steve running through our investments and the pooling issues in greater detail, and then Gary with the multitude of administrative issues that he has. I would like you to just take time, if you can, on the feedback survey that we have at the end. You know that we take that very seriously, and we've changed this annual meeting in light of your feedback in the past. So with that, I'll sit down, and I hope that you find the rest of the evening informative and interesting. And of course, as always, there will be light refreshments at the end just to sustain us on our way home. Thank you.
Right. That's better. Well, good evening, everybody. Thanks to Sue and to Dick as well, and all the other members who Sue's mentioned for coming here tonight. Can I just check, quick show of hands, who was here last year? Well, who attended this event last year? Right, that's great. Okay, thanks very much. That's kind of what we expected. So really nice to see everybody again. So as Sue said tonight, what I was going to do is run through a quick overview of how the fund has done in the last 12 months. So when we were not here, but somewhere else 12 months ago, we were reporting back on the year ended 31st of March 16. So this is looking at the year end 31st of March 17. But obviously some things have happened since then, so there'll be a bit of a mix about what's happened in the last year and some sort of more current events too, I think. And then I'll have a look at pooling as well and how far we've got to in terms of pooling. Just in sort of the general overview, when we did meet last November, we already knew the result of Brexit. And, you know, some things have happened since then, of course. We've had Theresa May coming in, elected as the new leader of the Conservative Party. A snap election in June 17. We've seen quite a few other elections going on, and a kind of movement against the establishment, I suppose, with Trump elected in America and also Macron in France. And then more recently, Angela Merkel back in Germany for a fourth term, but also a bit of turmoil in Spain over Catalonia and other elections happening around, even now, around in Austria and other republics in Europe, which suggest a bit of a move to some extent to the far right. And it's all a bit in the mix around what the heck's happening in Europe and Brexit. So we're living in interesting times still, by way of general backcloth to investments themselves. So in terms of how the fund did for the last year, what this shows you really is a snapshot for how, not just last year, but over 3 years, 5 years and 10 years, how we've tended to perform against our fund benchmark. So you can see, if you look at the top line, it's quite different to what we reported this time last year. We were talking about very low market returns in the year ended 31st of March 16. But what we've seen in the year ended 31st of March 17 is very high market returns. The equity markets have been particularly strong, and markets have performed quite well, and we have performed alongside that benchmark, more or less in line with it, at a return in excess of 22%. That's very welcome, and what it means is it's contributed to the fund's value increasing from 6.22 billions that we reported this time a year ago to 7.6 billion, roughly speaking. I think it's 7.3 or 7.6 billion, roughly where we are now. In terms of how the fund is actually made up, the elements that make up our 7.6 billions assets are comprised of UK equities, international equities, bonds that we call fixed interest, corporate bonds and government bonds, and alternative investments that we have in private equity funds, private debt funds, and investments in infrastructure, as well as a large property portfolio, which I'll talk about a little bit later, and the rest is always a residual amount in cash. And you've got two figures there. You've got a bit of a comparison in yellow, just show it, yes, yellow, compared to the, whatever that other colour is, to show you the change year on year. So you can see in equities, we're a little bit heavier than we were. And equally, international equities a little bit heavier. More or less the same in fixed interest, and indeed the other categories. And we did well from that because the equity markets were particularly strong, so being a little bit overweight in those areas helped to overall performance. I'll talk about property later on. You can see we're a little bit less in property, and that reflects the fact that we've been actively managing the property portfolio and selling some assets that we wanted to get rid of, and we're just waiting to buy other assets at the particular point of this, at the 31st of March 17. That gives you a bit of an interesting pie chart, shows you how assets, you know, the percentage of different assets that we have. So you can see we've got, if you look at the UK equities and international equities, we've got about over 60% at that time was in equities, and the balance of the rest is allocated as shown. So clearly we've seen a continued bull run, if you like, in the equity markets, strong equity markets. So being strong in equity markets has made a contribution to fund performance. That said, we have taken decisions in the last few months following a triennial review to reduce our exposure to the equity market by about 10% and put more into real assets, infrastructure, and into the alternative income area. That's investing in private debt and private equity and the likes. And that's a conscious decision to reduce the weighting in equities. So we'll see in 12 months' time how that looks and what that's done in terms of performance. This just gives an indication of the 10 largest stocks that we hold in equities. And, you know, those are reflected really in the different indices that we're invested in. There are some questions later on which address issues around climate change and why we have investments in oil, gas, mining and the like. And the reason is because if you look at, for example, the breakdown of the FTSE 100 index, if you want to be invested in these indexes and get a growth in the investment of the fund, get growth in the assets we hold, we need to be spread around and have a share of all of the things that make up the basket of the index. And that includes oil and gas and mining and other things. I mentioned property earlier on, and these just give you some examples of what's in the property portfolio. We have assets at the moment worth around about 640 millions. I mentioned that the values were less a bit compared to last year, and that's because we'd sold a central London office block that we wanted to move out of, but we've since bought some industrial estates in southeastern England too, and we're buying other properties. We've recently bought something in Reading for about, I think that was about 30 millions, and so we're looking for other opportunities to build back up the property portfolio. It is important to actively manage the portfolio to ensure that, you know, we're in the right places at the right time, and also invest in the assets that we have. So we do sometimes physically invest in the assets to bring them up to scratch. And there's probably an example in there, one of those photographs of one of the ones we've done that with. Just another example of property portfolio, Morrison's, Deeside Centre, Connacht Quay, sort of trading estate type development, but also to make the point that we unusually have quite a large investment in agricultural land, and that's an example of one of the places we've got some investment in the Norfolk area. So that's all I was going to say on the investment side. It's been a good year, or the year ended 31st of March 2017 was a good year for all funds. So all funds have generally seen a significant return compared to the previous financial year. So on to pooling. Some of these slides should look familiar to some of the things we showed last year when we talked about pooling. This is just a quick reminder of sort of where it all came from, or what the pools are in the first instance. The government has required the investments within the local government pension scheme to be amalgamated into 8 pools across England and Wales. And we've joined into the red area there, BCPP. And you can see there are 9 authorities which have got a coterminous boundary around them up in the north, which we're one of them, South Yorkshire, and 3 red ones down south, Warwickshire, Bedfordshire and Surrey, who want to be in the same pool as ourselves. And the others give you a bit of a guide as to what's happening in the rest of the country. And not surprisingly, Wales is all combining together. So there's a natural geographic link in most of the other areas too. What was the aim of pooling? Well, it was suggested at the time that scale would obviously lead to improved efficiencies, but funds still retain a need for a choice in asset allocation. So whilst we will be pooling the investments into BCPP Limited, South Yorkshire Pension Authority still continues to run and make decisions about how it wants its asset allocation strategy to look, and will hold BCPP to account for its performance through a joint committee with the other partners in the fund. The benefits of scale are up on there and sort of speak for themselves, really. Should be expecting to see lower fees through rationalisation of external fund managers, because within the pool there are 3 funds that are internally managed, largely internally managed, of which we are one, and 9 where they are largely externally managed and paying external management fees. The intention is to rationalise those and reduce the level of external management fees. There isn't any particular proof that larger funds will necessarily generate higher gross returns, though, so that's something that we will need to actively look at in holding BCPP to account to ensure that the performance is at least as good as the performance we've enjoyed in the past. There are some significant setup costs. We went into this last time. And South Yorkshire starts from the basis of being a low-cost, internally managed fund, so we don't get any immediate benefits from the pool. The more immediate benefits are likely to accrue for the externally managed funds who are going to make savings in those external management costs. But over time, the expectation is that we will get a reward, but it's potentially a 3 to a 10-year payback period for South Yorkshire Pension Fund, depending on how well BCP performs and manages costs. So the scope to move from the others who are externally managed to grow the internal management function, because we are an internally managed fund, we believe in that, we would like to see that happen within BCPP. But they certainly have, no doubt about it, by pooling, they have a scale benefit in bringing in investment skills together and making that much more resilient for the future. There is a quick run through the 12 partner funds that Sue referred to earlier. And as I said, 9 of them are coterminous boundaries up in the north, and there's 3 down south, Surrey, Warwickshire and Bedfordshire. And you can see the different sizes. We are the largest internally managed fund at 7.6 billion. This is the figures at the 31st of March 2017, so the numbers will have gone up slightly since then. And Tyne & Wear are the largest externally managed fund at 7.9 billion. So there's a total of 43.3 billion there as at 31st of March 17, representing, as you can see, quite a lot of scheme members and quite a lot of employers across the pool. I mentioned earlier that despite the fact pooling is going to happen, the asset allocation decision, i.e. where we want to put our money into equities, bonds or whatever, stays at fund level. And that's something that we'll continue to monitor moving forward. There is a process of pooling which is going to be quite onerous for BCPP to go through to get FCA approval to ensure that it performs in an appropriate way in what is in effect a regulated structure under the Financial Conduct Authority. So we get some, I suppose, some governance satisfaction from that. In terms of how we'll hold BCPP to account, there will be a joint committee, a supervisory body made up of elected members, and as Sue mentioned earlier, the chairman for that initially is John Will from North Yorkshire, and Sue is the vice chair. And it's on the basis of equal voting shares, supported by an officer group, and its principal function will be to really work with, in a partnership with, the board that run BCPP, but in effect to hold them accountable for performance. So there will be regular investment reporting back to the authority, to individual funds. There will be, at the very least, annual meetings of shareholders who are owners of BCPP Limited, but there will be much more regular meetings than that for the joint committee of members working together with independent performance measurement of how the pool is performing. So where we've got to at the moment, as Sue's referred to it, a lot of progress made in the last 12 months. Government signed this off some time ago. FCA approval is being worked upon. The top team who are going to run BCP Limited are well underway in terms of the appointments have been made. A chairman's been appointed, a chief executive's been appointed, a chief operating officer has been appointed, 2 non-executive directors are being appointed. So there are still a few appointments still to be made in terms of the other senior managers, a chief investment officer, a risk officer, risk and compliance officer. But that's well underway. It's been decided that there'll be an office location in Leeds, and that's narrowed down to 2 choices at the moment. And there's a lot of work underway now on transitional planning on how we transfer the assets and the staff into BCPP. It's expected to go live around about June 2018. And I mentioned the sort of things that remain at fund level about asset allocation management. So I'm going to take a few questions that have come in that we've received already and you've got there. I was going to take these ones. I'll leave them all to the end and then we'll get through the presentations. Yeah? Okay. So I'll skip through those. We'll take all the questions at the end. I've misunderstood that bit and then I'll leave it for you and Gary. Okay? Okay.
We're a bit quiet this evening. Oh, we're not? Yeah, it's good. Because I weren't expected to be here just now. I thought we were going through all them questions. Anyway, others have said it, but I'll say it too. It's good to see everybody. It's good to see faces that I see year on year. I'm here, so you might as well be. And it's really good that you do take the time to come and listen. The ones that have come previously, of course, will know everything that I'm going to say now because it kind of follows a theme. But hopefully you'll bear with me as we go through it. We're doing the annual review, so it's from the annual report. So it's basically what's in the annual report, and we just talk to it just to give a bit of flavour of various things that's in it. So I'm looking at the pensions admin side of that. The first thing we look at is the membership, which is always increasing because we're always adding active members to pensioner members to deferred members, and so it's always going up. And as you can see, the increase in the last year to March 17 of 2.41%. Active members up slightly 0.53% to 51,792. Now, you may remember a few years ago this was going down, but as we'll see when we go on to the next slide, we've now started to just more or less stabilise around that figure. Well, that's good because that keeps the active members and contributions coming in, obviously to support the employers' contributions that are coming in to pay the benefits that eventually arise. Pensioners up 3%, so more pensioners in than active members during the year, and deferred members up by 3.15%. And the exits which I've added in recent years. I don't think it appears in the annual report, but the exits, people who are dropping off the end of the things, where there's a mixture of deaths and withdrawals, and, which are mainly transfers and refunds as well. I will say that the people smiling in the bottom corner are the active members, not the people who have died. I'm told you've got a key in your pack for what this all means. On my screen I haven't got a key, so hopefully you can follow what's in your pack, but this just shows you the progression of membership. It doesn't say an awful lot. I think really if you can just follow the fact that if you were looking at a race going across the screen, clearly the total membership is always going to be winning, but the significant thing I think is that the bottom colour, which are the deferred members, which I think are orange, you'll see that they've actually gone further than the rest. So now the deferred members actually outstrip the active members and they outstrip the pensioner members, where back in 2013 the deferred members were just equal to the pension members and a long way behind the active members. So we're building up a lot of people who are not actually receiving pension but will receive pension in the future. So these are early leavers, people who have left before their pensionable age, and they've got options. I mean, they may not get to pensionable to receive the pension because they may end up transferring somewhere else or rejoining or something like that. But it is significant, just really in the context of that screen, that they're the one that has increased the most. But I can't really make memberships that interesting, to be perfectly honest. Scheme employers, you'll know I've mentioned this year on year, and this table does show it all. I mean, in big numbers, the scheme employers are going out of sight, and I say this, I know I say it every year, but again, in context of the active members, which I say ain't changing very much, the employers that those members work for are. So the employers that we've got here are still representing the same amount of active members, but they're just different employers. And so this year I thought, well, what I could do is break it down for you so you can see where these employers lie, and it's obviously in front of you as to where most of them are. Scheduled bodies are the councils. South Yorkshire Pensions Authority is a scheduled body. Scheduled just means it's in a schedule in the regulations that it comes from, but it is a scheme employer. But there are 18 of those, so not many. Academies, this is the growth. This is where people are coming out of the council education authority into their own employer, being responsible for pensions themselves rather than the council. 258. Community admission bodies, those are charities and small organisations that typically came in quite a number of years ago. We don't see many of them now because of the cost of the pension scheme. The pension scheme is quite costly for employers, and so we don't see many new ones of these because they don't actually meet the criteria, because they can be risky, obviously, if they come into the scheme and then can't pay the contributions. So we've got 40 of those. Transfer readmission bodies are where the local authorities and other bodies outsource services to the private sector. Scheme rules allow the scheme members who have been compulsorily transferred to retain their benefits and therefore can stay in the scheme. So we've 102 of those. And resolution bodies are parish councils, typically for 1 or 2 members in each of the parish councils. So it's not massive numbers of members, but they are entitled to be in the scheme, and we've got 21 of those. So all in all, there's at that time there's currently 439 with active members there, with a further 42 in the pipeline. So they look like they're going to be joining the scheme. They may not all join the scheme because we get applications and some don't go through. But you can see that this time next year, this figure will be much higher. And we also have employers who no longer have active members, but still have members who are pensioner members or deferred members. Maybe some of you actually worked for one that no longer exists. So in total, we manage 546 employers. Our performance. bane of my life, I guess, in terms of trying to get this back to where we were a few years ago when things were a lot rosier. I've come on to further slides about performance, but in the year that we were talking about, we did 60,798 cases, and that is actual case work as opposed to the other stuff around it that we also measure as well now. But that's still a lot of cases for the number of staff that we've got. Disappointingly, as a number, 70.39% on target. Actually, a lot of hard work went into getting to that number, and it is improving even more, and I'll come on to that. But that's as it was and as reported. So it's not perfect. It's not in the high 90s where I'd prefer it to be. In the year, 10 formal complaints. This is stabilised now. If you remember a few years ago when we had the new system and we were building up backlogs of cases and things like that, this went up to 30 odd. It was still a very small percentage of the total workload, but it still was a lot more than we have. But 10 out of 60,000 is 0.01%, rounded up somewhere, but it's still a very small number. And good as well, a reduced number of informal complaints, because we don't do everything right, nobody does, and we have to admit that. But if we can put things right for people, then obviously will, and this it shows in the reduced number of informal complaints that things are just getting done, which is good. Overall satisfaction, which we take from the surveys, like the ones that we're asking you to complete, and what we issue to various events that we do up and down the year. Members 84%, employers 95%. Employers really good. Members could be higher, but they are surveys, and often we get a poor return from surveys. We'd like to think that everybody in this room today would fill it out, but we know that you won't, because that's what happens. And the same with other ones that we issue. And of course, if people have got an axe to grind on their survey, then they make sure that they do. So you tend to at least take a notice of that. So overall, with 84%, I'm quite happy with that. Benchmarking. In the annual report, we always show you the benchmarking from the year before. So if you've seen the annual report, then that's what you'll see, which is what I would have said this time last year, because the benchmarking survey comes out around this time of the year. So this is for 2017, not the one that's in the annual report, so it's current. The disappointing aspect to this, and continues to be disappointing, is the number of LGPS funds that take part, because there are 99 and only 30 want to fill in the survey. Now, we have to pay a bit of money to be in the survey, but it's useful to us because it puts us as a measure of where we are compared to it with our peers. The fact that the others don't, I could be cynical and say, well, they've got something to hide, but who knows? Maybe it's a finance thing. The overwhelming thing for me is it's disappointing that isn't compared with 99, because that is then a true reflection of where we sit within our universe. But the fact is, we still come out pretty good, and that's how we have for as long as I've been doing it. And we're below average cost. That's the critical number for me. The amount of money, £15.40, varies every year, because it varies on amount of members and things like that. But as far as we're concerned, as of now, we're paying £15.40 on each of you for the service that we provide. So that's what it costs to provide the service to you. The average of the other 29 is £20, so we're well underneath the average, and that's good. That's where we want to be. There's all sorts of other things in the survey, and I'll just pick out some things to show you, which is really back to employers. At the time we filled this in, it was 420, the average is 308, so it shows we're much bigger than the average. I like doing this one because I'm a Yorkshire lad, so we like to take as lump sum. So 82% of our fund take as much lump sum as they can when they retire, get the money in the pocket. Whereas it surprises me every time I see it, the rest of the survey is 56%. So but it's noticeable, and it doesn't change very much from time to time. And then a bit about us in the staff experience. You know, I've been here as long as you know, a long time. But greater than 15 years membership for our employees. We've got 44% of our staff in pensions admin who've been here more than 15 years, which is great because that means that we're experienced, and it's a difficult scheme, really complex regulations, and by keeping staff and keeping experienced staff can only work well for providing the service that we do. And you can see there we're much better than the average of 31%. So, and long may continue that as far as I'm concerned. We had our 3-yearly, the main customer service excellence review in April. This comes along every 3 years. And pleased here to say that we managed 100% compliance in every category that we do. Thanks to Joanne, who did all the work behind that. We were managing on every single area to be fully compliant with what is a stringent test. It's not easy to get this, and not many other local government pension funds have it. But we've had it, as you can see, since 2004. It was charter marked then, but in the same kind of thing ever since 2004. And every year we're reviewed on how we are doing, and then every 3 years we have a full review that we did. And there were some nice words from the assessor that you can read at your leisure, but I put on there because I think it does really mean something, particularly since we've had the difficulties that we've had in the 3 years since the last review had taken place for us to still manage the full compliance. And I always say it's not about the award, it is about the customer experience, what we've got to try and provide to our scheme members, you, the scheme members. This is the icing on the cake for it, but you know, it is gratifying that we can actually prove that we can meet this criteria. I don't know whether you remember this guy. I'll just take you back a few steps. These are just sort of screenshots from my presentations over the last few years since 2014. The screaming guy is how I felt at that point in time, inwardly. Never showed it, but inwardly it was always there. I used to go home and that's, I mean, this is when all the fun started, as I like to think of it. 2014 brought the new scheme. So that was LGPS 2014, and that was a big change. The scheme is significantly different and significantly more complex. And the worst thing about it is you can't forget everything that you knew, so we've still got to administer the old scheme as well. We bought the new system, and the new system in 2014 would have been going live around the time we were doing this presentation at that time. We went live in October 14, so we've been on it 3 years and we call it the new system. But it just shows you how time flies, I guess. And we also had the actuarial valuation in that year too. So it was, I don't know if you remember, I had a perfect storm image as well, and I think that really summed it up that year. But it was busy, but it was the start of the performance slippage, where in that year I would have probably been reporting that we were performing at sort of 98% of things on target. 2015 was my annus horribilis, which is still the screaming man was in my head. And performance had dropped to an all-time low, and I was standing here trying to defend that, and it wasn't easy, and we didn't complete as much casework. As you see, we did 60,000 last year, only 44,000 in that year. But things were starting to get a little bit better, so the bit where the red banner is showed that for September 15 at least, we'd done 60 again after that, so I was a little bit too hopeful. But then last year, somewhat to my own ends as much as anything else, but I showed you this, which is really a comparison between 1996 and 2016. I'd done a previous one from 1976 when I first started, and then so I'd added this on. But the tale behind this slide was the fact that nearly everything on the right-hand side had gone up exponentially. They'd all gone up by massive percents, but the staff they've gone up by 4. And that was the start, really, of the process for me reorganising the team to bring in extra staff, to justify the need for extra staff and the recovery that we've now embarked upon. So that's where we were. So what did we do? So from talking to you about it last year, I started the process of working a way of reorganising the office and bringing in extra people to make sure that in the future we're not talking about these performance dips and things like that, that we are able to continue to provide the service that we do to you. So effective from 1st of April 17, we bought some software and we brought some staff in, a data team as you see there, to change the way in which we bring contributions in from the employers. So if you think back to the number of employers we've got, they're all paying us money. And they're paying us money every month, contributions that the employer pays and contributions that they collect from the members' wages. And up to press, what we do is we take the money monthly, but then we say to them, every year, at the end of the year, end of March, send us a list of what everybody's paid, and then we can put that to their members' records. Well, when we had 100 and odd employers, it weren't too bad. But when we've got 500 or 400 and odd, as we have now, it's becoming a nightmare because we find things on the returns that they send us that are wrong. And we find that members appear that we've never heard of, so that they're not on our record, so we can't put it to their record because they've never heard. And then we find that people have left and they haven't told us that they've left. So it's a major, major job. And not only that, is that we've got a statutory responsibility to send annual statements. If there's any current members here who are currently working, you'll know you'll get an annual statement from us, and that annual statement has to be sent out by the end of August, and we have to do it, also we have to report ourselves to the pensions regulator. And the gap between receiving the returns, sometimes by the end of May, if we're lucky, and the end of August is very short. And to do all this is a major, major job. So what we're going to do from April 18, you can't start it immediately, we've got to have a building period, but from April 18, we're going to start doing this on a monthly basis. Now, you might say, well, that's crackers. If you can't do it on an annual basis, how can you do it on a monthly? Well, we're going to do it in a different way. We're going to get feeds from the payrolls of the employers. So if they put somebody on payroll, we'll get to know about it. And that means it's a new starter. If they say take somebody off the payroll, we'll know about it, and that means it's a leaver. There are changes and other things in between, but the thing is that we will be able to manage this more on a monthly basis so that when we get to the year end, we've got all the information that we've got. When it gets to the end of March and they pay it in end of April, then we'll just add it to the other 11 we've received, and we've suddenly balanced the books, and that's what it's all about. Slightly more complicated than I'm making out, but the theory is good. We know it works in other areas, and we're going to start rolling this out with employers. But we couldn't have done it with the staff that we've got at the moment. We had to take on more people. So we brought 4 new people in to complement a data team of 6 staff, and they have already good. Also put a performance manager in place, which is a new post, and I like to think of it as a whip cracker, but it isn't really. But it's someone that is keeping an eye on the work in the office and has got all sorts of dials and metrics on their desktop to be able to keep an eye on where work is, and if things are going out of time, to make sure that it doesn't go out of time. So if we're going to miss our performance target, then to do it. Now, we still are missing performance targets, don't get me wrong, but the aim of this is to miss it less, and as time goes on, this will gradually improve. I've also strengthened the technical training and system teams because we need to support our member services staff. Member services staff are the key because they are the ones that do the casework. They are the ones who pay the retirement benefits and so on. But they need support. They need systems to work. They need guidance because the scheme's complicated. They need training and everything else. So it's not money ill spent. It's money well spent. And so far, how's it going? This is just a sample which I took from my desktop of this kind of dashboards that we've got available to us now in the office, so we can see the work as it's going. If you look at all cases in the bottom right, it says 87%. So that was for the period 9th of September to 9th of October, when I actually printed it out. But what that shows you is that that's away from 70%, which we were doing at the 31st of March 2017. And this is continuing. My favourite phrase in council meetings now is incremental improvement, and that's what we're getting. It's going up all the time. And so it's working. It should continue to work. It will get better when we get the monthlies coming in. Monthlies will take a time because we've got to do it for a year, so it really won't impact until 2019. So we're in it for the long game, but incremental is what we want, and hopefully in the right direction. Right, a bit more light stuff for you. Facts about the membership and the things to do with the statistics that we put in the annual report. So these are up to date, so they're not the annual report figures. I've just taken these from the day that I did it. I've got a system on that I can just run, and it tells me all this kind of stuff. So 52,787 active members, so that has gone up a bit from when we were on the annual report, but 72% are female, so it just shows you that the changing nature of local government pension scheme, which if you'd look back into the 1980s would have been more males than females, it's definitely more female orientated. 47% is part-time now, so that's a significant amount of the workforce clearly will work part-time, and 90% of those part-timers are female, so males are not really taking on part-time work at this stage, but that may change in the future. 8.5% of them have got more than one job, and this is a trend as well, that we have quite a lot of people who have more than one job. Do you want to hazard a guess, anybody, as to how many jobs the person with the most jobs has got?
16.
How many? 16 or no? 8. God knows what they do and how they fit it all in, but 8. Most have got 2 jobs, which is kind of what you'd expect. But quite a lot have got 3. So, and that's an increase in. So again, it's showing, and it may be that the jobs that they do are the same, but for different people, so for different employers. So you can imagine, say, a cleaner who might clean in one establishment in the morning and then clean in another one in the afternoon and another one in the evening, for example. But it's a sign of the times, and I think it's the nature of employment within the local government pension scheme. And I'm sure we're not out of step with other funds. So that's active members. Deferred members, said this is the increase in number. So there's 52,212 when I did this. But their average pension is only 1,481 per year, which ain't large by any stretch of the imagination. And 48% of that number have an annual pension of less than £500 per year. So it's a very small amount. So we're dealing with a lot of people here with a small number of pensions, because if that's 48% of them, that is a small pension. Only 7.8% have a pension higher than the average. So there's some way up there, of course, but a very small number of more than the average. And we've lost touch with 6,090 people who have got deferred pension, but not surprisingly, 53% of those have got a pension less than 500 quid and probably don't care. But we will find them. We don't let them go, and we don't have a little fund that we pay it to ourselves, but we will find them at retirement, but we just don't bother finding them just at this moment in time. And on to pensioner members. The average pension has crept up a little bit. I think when I did this before, it was about 4,500 or something like that. So it's up a bit, but you'd expect that this thing will increase slightly as pay creeps up. But it's 4,886 again, which isn't massive by any stretch of the imagination either. 69% are below the average pension too. So again, it's significant that it's, people do talk about this as being as a gold-plated pension scheme, but these figures don't bear that out. There's 22 centenarians. It's not centurions, I've looked it up. It's definitely the right word. But there's 22 now. The last time I did this, there was only 11. So we are living longer, but bad news for the guys is that 77% of them are female. So, you know, that just shows you, doesn't it? The oldest member is 103. Unfortunately, our oldest member of 111 did die this year, which is sad, but so we're back to 103. I know this is one of your pensioner members come for. This is your pay rise for next April, and this is genuine. And in previous, I've only had it as a draft because due to the date, the order hadn't been published, but it was this week, and it's 2.8%, and it will be paid from the first Monday after the 6th, which is the 9th of April. Pensions increase history, just to show you how things have gone, and at least we've not on the notes that we had a couple of years ago and 2010. And I've got to my questions. Can I take my questions? I will take my questions. Right. How many members have transferred money out of the scheme since deregulation? I've written this down because I can't remember it. So deregulation is the pensions freedoms, where the government decided that it would be fun to allow people to take all their pension as cash once they reach 55, which as a pensions professional is a bit weird to me, but nevertheless that's what they did. We've had, since April 2015, 1,187 quotes, so that's 1,187 people asking for information, and 74 actually taking the money. That 74 raised £7.5 million, which is an average of £101,000 per member who took it. So they're taking out all their pension as cash. There will be some tax element on it, so they'll not exactly get all that. But that means they get no pension and choose what they do with the money, then that's it. The highest one that we've paid out is 815,000. So it's a significant amount to that person, who obviously had a lot of service and quite a bit of pay. But there you are. So that's it. But I think comment from me is that that's okay. It's not many. It seems as if out of the 1,000 and odd that asked for it, they took the financial advice, because you have to take financial advice before you're allowed to actually take the cash. And most of them got good financial advice because they stayed in the scheme and kept the pension. So essentially that's worked, and 74 out of that ain't too bad. The other question is about, it was a longer question about, was I going to be covering the pros and cons of retiring before normal retiring age? And the answer basically was no, I wouldn't be, because that's not what we do at this type of meeting. If you wanted, I could do a good hour session for you, but I'm sure you'd probably not be interested. But we do run them at our pre-retirement sessions, and we do run them at our midlife planning sessions. However, since we were asked, just to give you a flavour, it depends on the individual. It really does. The pros and cons are down to individual circumstances. So if I'm talking to somebody, and please, if the person who raised this is in the audience, come and see me and I'll talk to you about your own circumstances if you wish. But if I was talking to somebody, the first thing is, well, you know, how early is early? Because if you're 55, you're quite a bit away from your normal pension age. And so that's going to bring in significant reductions to your benefits. So it might be nice to retire at 55, for sure, but there is a cost to that. So really, is how early is early? I mean, today, you know, with a normal pension age for some at 68, well, 65 might be early, when I guess most people wouldn't think 65 would be early, you know. So, but times are changing, and as you know. It depends on the individual and how much membership they've got, sort of the level of protections that they've got in place. So if you've got pre-14 scheme membership, i.e. you've been in the scheme a while, you will have got some protections going back from the old schemes. And they are valuable to you because they can cut out some of the reductions that you would get. I'd ask you what reason is you're doing, because it could be, and this is where it becomes personal, it could be that there are significant reasons in your life, in your family life or in your own personal life, that make you want to be retiring at this moment in time. And there could be all sorts of that. So those reasons are very personal, but so it's not it's a pro to you, but it could be a con to somebody else without those circumstances. So it's just about that. In terms of pensions, it would be, well, is it the main or a second income? Because if it's your main income you're giving up and you're retiring, you've got to live off that pension because you're the main breadwinner. If it's a second income and you've got a large other income coming in, or somebody else with a pension that adds to it, then of course it's a pot, and so then it may become relevant to you to take that. So it's all that kind of thing. But as I say, it's a really personal thing. But I'll repeat, if the person who raised it wants to see me, then I'm happy to talk to them about it. I think I only had 2 questions. Is that me? Thank you very much. Thank you.
Ladies and gentlemen, can I take you back to page 16 in the fact the reason why we did it the way we did it was we felt that particularly the questions around Steve's presentation were likely to prompt some additional or supplemental questions. Conscious of the time, conscious that we want to feed you as well. So I won't be rude if I try and cut people off. What we're going to do, Steve will go through those 9 questions. Start off, he's going to do it sitting down at page 16.
People online and what?
Oh, I beg your pardon, sorry. So go page 16 in the pack. We'll go through those 9 questions. If we've got time at the end, we'll take some additional questions. Don't go home frustrated this evening. If there are questions and you don't get the chance to have your question answered, then please let us know, and we'll email a response back to you, and we'll share those questions and responses with everyone as a feedback to tonight's event. Okay, so Steve, over to you.
Cheers. Thanks very much, Martin. So I think the first question was, I'd like an update on developing an ethical investment policy. Well, we have a responsible investment policy, slightly different language. It's responsible investment, which takes into account environmental, social and governance issues, which could have a material financial impact on companies and performance, and hence our interest in them in terms of their overall return to the fund. That policy has been recently reviewed, and it's available on the authority's website. So I'd encourage anybody who's interested in having a look at that to go there. The second question was, how will Brexit affect pension funds? Really difficult one to know. I mean, what I was talking about at the outset was all the things that are happening in Europe and the world, and what's going to happen with Brexit negotiations. We don't really know. I mean, I guess could have said earlier on that when we talked about fund performance, that we have actually weathered the initial storm of Brexit. There were initial concerns that it would have a dramatic effect on the economy, and that hasn't been watered through thus far. Performance has been strong in terms of equity markets, although it has led to the devaluation of sterling, as you've seen. That had an impact on the fund positively, because the European investments that we have, denominated in euros, went up in relative value. That said, that in itself did lead to an increase in inflation, and we've seen this week inflation rise to 3%. So, it's difficult to say what will happen in the future, but so far, sort of, so good. So I think we just have to watch this space in terms of what might happen in terms of Brexit. What else? The next question was, what is the current situation with our funds invested with Icelandic banks? How much do they still hold? What's the rate of return now? Are you content with the way the things stand? So it was a great question, that last one, isn't it? So I think we're well beyond the sort of Icelandic banks issue. Have I missed a question out? I think I have. I'll come back to the one on probity, since I've started on Icelandic banks. Sorry, that's just my management of the papers in front of me. In terms of the Icelandic banks then, we've had about, well, we've had all we're going to get back from the Icelandic banks. We had about 18.5 million loans advanced at the maximum level. We've now had about 92% of that back at 17 million. There was quite a process that we were engaged with the local government association at the time, who were negotiating for a lot of local authorities and funds in trying to recover funds from Icelandic banks. So against the worst case position where recovery was as low as 14.5 million, I think we've done reasonably well to get up to 17 million as a final result. And are we satisfied with that? Are we content with the way things stand? Well, it's as good as I think we're going to get out of it. Can't be entirely content because we didn't get every penny back. So that's where we are on Icelandic banks, and I think that's a closed book now. Going back to probity, how does the South Yorkshire Pensions Authority ensure probity operates in the organisation? Well, I think we'd say that we're very proud of the very high standards that the organisation operates to. Personally, I think if anybody dips into the websites of how our meetings are conducted, the authority meetings, they're an exemplar, frankly, in how business should be conducted, in my view, having been now in the organisation for as long as I have. The meetings are public. Some confidential papers aren't, but the majority of papers are in the public domain. It's on their own website. We're subject to internal and external audit. So we have a corporate planning and governance board, which met this morning, actually, which is our own audit committee, which receives papers from internal and external auditors commenting on performance and raising issues bringing any issues to the attention of members. We're subject to review by our own independent local pensions board, and we've got 3 colleagues from the pension board here tonight. The chairman, Glyn Boyington, Jill Thompson and Sue Ross. That's nice to see all 3 of them here tonight. And they exercise another independent view over what the authority is doing. We have on the investment board, which looks after some of the stuff I was talking about at the outset, how the investment performance is working. We have 3 independent advisors on that board, and they are very challenging, as the members of the board will testify to. They're not slow in coming forward with any questions. They get straight into our ribs on certain issues, and I think that's an excellent example of very good governance. What else can I say? We're also subject to regulation by the pensions regulator, and Gary could talk to you all night about that. They are getting more interested in what, particularly around the administrative side of the fund and how we perform. And we've struck up a good relationship with them already, because I think our performance is acknowledged as being inherently strong, although we're all capable of having issues from time to time. And we're also subject to regulation by the Financial Conduct Authority as well. And all of our key investment staff are approved by the Financial Conduct Authority. So I think our governance standards are second to none, frankly. So the next question moves on to climate change. In the SYPA climate policy report, etc., based on the results of monitoring. So that's talking about the carbon audit. Well, we've commissioned another carbon audit. We agreed as part of our policy that we'd do that periodically. We've only just recently taken a report to members about that, and we've commissioned a new audit, and we should have the results on that by the end of this year, where we can make some comparisons then with the report from 2 years ago and see how the fund stands in terms of its carbon levels. The next question is on a similar theme. There's a few on climate sort of change and carbon. Environment Agency pension funds now in surplus with strong investment returns after its decision to reduce carbon in its portfolio, demonstrating that carbon reduction does not automatically equate to reduced returns. Does the board plan to follow this good example and take positive action to build on the policies of tilting towards a lower carbon portfolio? Well, effectively, we have tilted a bit towards a lower carbon portfolio. I'll come on to that in later questions. But actually, the reasons for the Environment Agency's surplus are more about the overall market and about the strength of equity performance, as I mentioned earlier. So they delivered 19.6% return in 2016-17. We delivered 22.5%, as you saw on my earlier presentation. So, I hope that answers that point. Next one was what progress has been made in tilting SYPA's investments, etc. Well, since April 2016, we've put an extra 90 million into alternative investments. And on one of the slides I had up, I talked about alternative investments and how we've decided to reduce our exposure to equities and put more into alternative investments. So that's things like infrastructure and private debt funds, private equity funds. Many of those things are in the low carbon areas or in infrastructure around rail, hydro, gas transmission, rolling stock, but also in things like waste to energy and sort of bioenergy infrastructure, including one quite recently in a biomass plant in Yorkshire, well, East Yorkshire in Hull. Still call it Yorkshire. So we've put 90 million into that area, and we've also invested in social housing through real estate investment trusts. So we don't directly invest, but we are part of a trust which is a bigger entity, and it gives us an opportunity to get some investment into those social housing areas with a number of social housing bodies that are funded through those trusts. Another one on climate policy, it's saying what our policy states in terms of tilting portfolios in favour of lower carbon assets with a view to progressively decreasing exposure. And how do we reconcile this with the fact that published investment holdings suggest that our holdings in fossil fuel companies went up between 2016 and 2017? Well, actually, when I showed you two slides. I showed you the 10 top holdings we have, and then I showed you the index and why we invest in those, because the index is weighted into oil and gas and mining and all those things. If we followed that index and had all of our money in there, well, we'd be at 100%, if you like, but we're at 80.5% of the index weighting. So we're 20% less, more or less, than if we just followed the index. So we have tilted our policy to that extent. And whilst some holdings did increase slightly in BP and others, Glencore, they did reduce in other areas, a mining company and in oil companies, to compensate for that. So I think we can say that we have actually addressed that. The next one talks about the pooling of local government pension schemes, and it's really getting at how will carbon funds be dealt with under pooling. What plans now exist to ensure there are low carbon funds and strong responsible investment policies in place which build on the work already taking place at SYPA. Well, we are leading on responsible investment. We've got one of our officers who is leading that work on behalf of BCPP. She's at a meeting today, at an AGM meeting, exercising influence over one of the mining companies that we're talking about. And so our policy is to engage rather than to look to divest. We look to try and persuade businesses to move in this sort of direction rather than look for overall divestment. Had you not been there, I'm sure you should have been here tonight. We've got a very strong responsible investment policy, as I mentioned, and if you dip into the authority's website, you'll see that that's recently been discussed by the authority, and it's used in effect as the blueprint for BCPP. So we're trying to align our views on responsible investment with BCPP and encourage that alignment, therefore, with the other 11 partners in BCPP, so that we're all on the same sort of playing field around responsible investment. I do expect, therefore, that the issues around carbon funds will be on the agenda and get discussed as things move forward. And if there's sufficient demand from the 12 partner funds, that will have to be addressed by BCPP moving forward. And I'll pause there. Thanks.
Thank you, Steve. The chips are in the fryer. We've got about 15, 18 minutes for some questions from the floor. The gentleman here indicated first, and then I'll come to you, sir. John's at the back, so we'll try and get round the room as quickly as we can. But if we go with you, sir, then could you just... I'll give you a microphone.
A quick one for Steve, actually. You did mention, Steve, pretty early on about putting money into investment in, I thought you said personal debt originally, but then maybe it was private because you used the word private. What do you mean by investment in either personal or private debt?
Can I borrow that back? Sorry.
No, you don't need it, Steve.
Oh, I don't need it. I'm like, sorry, apologies. Fine. Yeah, sorry, I should have said, it would be lovely if it could be my personal debt, but I should have said private debt funds, private equity funds. So it is Private equity is sort of partnership companies that come together where we can take some of the actual equity in things that they're investing in. And private debt funds is where people are providing resources that banks traditionally provided.
Yeah, but does that mean that people are borrowing money and then you are lending them that money so that you'll be in a position where you might have to then chase up the repayment?
It means that we are providing the cash to people to fund businesses where businesses would have normally relied on banks. So there is risk there, but there is return too.
But it's businesses, it's not individuals.
It's businesses, yes.
Could I ask a quick question then of Gary? Gary, you did show in your charts that it was the membership. You were showing that the deferred members were gradually growing and going past the active members.
Yeah.
Bearing in mind that there is this life expectancy increasing, which you also mentioned, does that mean that there was a potential liability in the future that you might end up having to find funds that are diminishing?
Yeah, it's the nature of funding. I mean, the pension fund that we've got is a mature pension fund in that the liabilities eventually will, in terms of cash flow from contributions coming in, the benefits going out won't pay them. So we'll have to realise assets. But that's the trick that we have to do at the actuarial value. Well, not really, because the nature of pension funding and actuarial science is that what we've got to do with this pension fund is pay the last pensioner their last penny on the day that they die. So every 3 years we go and we do an actuarial valuation of the fund that says what is needed in the pension fund from employers, taking into account the employees' contributions as well, and the investment performance on the assets that are in there. At some point in time, the assets that we have that will be in equities and things like that at the moment for growth will be moved into defensive assets such as bonds and things like that to then just pay out the cash. And so if anybody's ever around on that day, that's how it's supposed to work. That is the nature of pension funding. The problem comes, and the problem has come, when the fund's in deficit. That's what I'm thinking. So because if the fund's in deficit, then there isn't sufficient money in from what should be in to balance the books, so your assets and your liabilities. What we've got with the fund employers is a plan, which is a long-term plan, but they're paying money back over and above what is needed for future membership to pay back that deficit. So each employer in the fund, not all employers in the fund are in deficit, even though the fund is, but the ones who are in deficit are actually paying extra to meet that requirement. If at any point in time the cost of the scheme becomes too expensive, then there is a national cap that would limit the employer contributions, and it's at that time then you have to look at the benefit entitlement, not for what's being paid to pensioners already, but to existing employees, and maybe there's then a discussion about how to change the pension scheme in the future should that happen. So there are protections in place to ensure that you can manage the pension fund going forward.
Gentleman there, John. Thank you. Thanks, Gary.
Right, so I don't want to put some points to you people. Get your pens out and write this down.
Can you keep your question fairly brief, please, because we're running out of time.
Right, first of all, I worked on a bins in Sheffield, and we finished through it all in 92. It was 2006 that I found out I had emphysema and asthma. So can you go through all the old bin then in South Yorkshire? I worked on the old bins. And if I've never had pulmonary tests, please get all and go there. Now, the second thing that affects the British economy. The northeast of England is the only place in Britain that exports more than we import year in, year out. Now, we've had city regions dumped on us by Westminster and the Labour-run councils. In Teesside, in the South Vale region, and up in the North Vale region, from North Tyneside to our boundary with Scotland. Now, if these city regions fail, the British economy will go with it. Make no mistake about this. And on top of this, we got them idiots in London dumping these boundary changes on us. And with, believe this or not, half of South Teesside, the second biggest industrial area in Europe, is going to come under an MP from our next door neighbour in North Yorkshire, which is the biggest rural area in England. So this is what you're dealing with. So take these on board, because if we go down, every council are going to have to start paying people off.
Okay. Thank you. Thank you for that statement. No, that's very kind. There were some hands up over here. Gentleman there, John. Thank you. Thanks.
Thank you, Chair. First of all, I'd like to say how pleased I am with South Yorkshire Pensions. I'm completely satisfied. I'm glad you've allowed some supplementary questions, because the questions can arise from the presentations that you give. And it's my questions to you, Gary. On page 22, you show on the annual review cost per membership, and you compare it to 30 other local government pension schemes. I would have found that helpful if you compared that also with the schemes that we're going to join with in the Borders and Coasts. Because it seems like we're going to take a hit on that, because we're efficient and they're not, or they're less efficient than us. And can you tell me whether their funds are in as good a shape as our fund is?
I can't, because I just don't know the answer to the question now. I could, so it's something that is available. I couldn't. We signed confidentiality in relation to the benchmarking survey. That's why I can't publish the report to the members anyway. But I could give you a general answer if I looked it up. But I don't even know whether they have a part of the 30 that have participated, because there's 99 funds. So whether our partners in BCP have all done, I think I know a few that traditionally have participated, but I don't know for certain whether they all do. But the fact is that they all have annual reports, so effectively they're all public documents, and their performance should be being reported elsewhere, which is not helpful to me to tell you that now, but it is in the public domain for each authority to know how they are performing.
I understand that you don't tell me if you've got confidential, but surely you must know if you're going to join a fund with other areas, if in fact you're picking up a lot more admin costs than we've already got.
Well, it's not.
I was going to say, the pooling arrangements are the pooling arrangements for investments, not for the administration of the pensions, which is what you're seeing here. So actually this isn't, I mean, it'd be an interesting question just to see how they were doing on that. And it might be, if pooling goes particularly well, the government might look at, if you can pool your investment service, could you all pool your administration? That wouldn't be a million miles away if the investment goes well. But it's I would think that's years and years down the line. I would think, but it's a valid question of, if pooling is so good, why don't you do it on the administration side as well as on the investment side?
Okay, thanks, Peter. Any other questions? Gentlemen, they're working hard tonight, Johan, sorry.
It really rides on the back of the previous questioner. I think, Steve, in your presentation you mentioned that the Warwickshire, Bedfordshire and Surrey, and particularly Surrey, requested to join our pooled scheme. I'm just curious as to why these strange bed partners want to join the North.
Yeah.
Well, perhaps I can talk about some of it, because obviously I see the other chairs when we're on this. I don't think it was any coincidence that I met the chair of Surrey down in London before pooling, where I told them that we were, I think, the only FCA registered pension fund. She was absolutely amazed. She'd never heard of a pension fund being FCA registered. And as we now know, the government said all these pools have to be FCA registered. And I think that might have been one of the things that she thought, that South Yorkshire were comfortable with FCA registered, you know, very comfortable with. We work within that, and other pension funds don't. I think the other thing that was particularly why BCPP got together with all of its constituent parts is that we have internal investment that a lot of people admire and envy and wanted to avail themselves as. And one of the guiding principles of Border to Coast is that we strengthen our investment team so that everybody can do that. It is really great value. I mean, I haven't got to say cheap. It's a cheap way of investing, though, and we do it, and it's down to our staff that are matching the big city people on investment returns. And we should all be very proud of them.
Okay, thank you. Thanks for the question. Any other questions? Lady at the back there.
Thank you. In Steve's presentation, I think it was mentioned that the Leeds office for the pool was going to open and that there would be changes, possible changes in the SYPA officers. Could you elaborate on that a little if you can? Who's going, who's staying? Do we know that?
Is my mic on? Yeah. Yes. The BCPP need their own headquarters. Leeds was chosen as a strategically sensible place to have a future skill set, recruit people, be able to get to. You know, after quite a lot of discussion actually about where it should be, what the rationale was, but I think the broad rationale is it's going to be in an office within walking distance of a major station. It's in Yorkshire. It's therefore accessible, certainly reasonably accessible for our staff who would transfer there. So from SYPA, the starting point is that our investment team will be on a Chibi transfer list to move into that office at some stage, probably around about June 2018 is the current plan. Yeah.
Okay. Thank you. I'll take one more question. Anybody? Yes, sir. Yeah, just wait for the microphone. Sorry, it's coming now. Thank you.
How much money we are going to give to the pools?
How much money?
Yeah.
Well, we have 7.6 billion as at the 31st of March 17. That's probably gone up to about 7.9 as we speak now through different iterations. We won't be giving it all because we will initially retain, there's no plan to transfer the agricultural portfolio in at all because that's quite a unique thing. So that's likely to stay with South Yorkshire Pension Authority. Over the first few years, we won't be transferring the property portfolio because that's a specialist area of work and that will require BCPP to gear itself up to be fit and ready to take that on. And a decision about that will be at least 2 years down the line. So that's probably about 700 or 800 millions that will stay with the fund. We will have assets that are already committed in certain areas around of our alternative investments that I talked about, where we've invested in private equity and private debt funds, where we will continue to manage those in runoff, but any new ones will be run through BCPP. So there's a bit of extra in there. And we also will be running a bond portfolio. Most of the bonds we manage internally, but we have an external bond manager for a small amount, relatively small amount of bonds. That initially will stay with us until it can be transferred. So over a period of time, most assets will transfer in. Agriculture, there's no plan for it to transfer in at all, and property may or may not further down the line, and there'll be some elements that will be running off, but the majority will go.
It won't be like Brexit.
Will it be?
Like Brexit.
Well, rows about shares of money might be a little bit, and about like Brexit. There seems to be, but that's a, you know, there'll be issues about sorting out detail between the 12 of us, I'm sure. But I don't think it's fair to say that it'll be quite like Brexit. I hope not. You'll get a deal. Yeah.
Thank you. Ladies and gentlemen, I'm going to ask the Chair to close the formal part of tonight's proceedings. But suffice to say, obviously, Steve and Gary and Sue will be outside, so if you want to call them, wait till they've got a large sandwich in their mouth and then fire a good question at them. OK, so thank you. So, Sue. You can.
Yes, I don't really have anything more to say than that, but thank you all for coming, and do avail yourself of the officers and me and my colleagues if you do have questions. As soon as I walked in, somebody collared me. So I know you won't be shy in that, and we're only too happy to answer any of your questions. And enjoy your light refreshment. Thank you very much.